Welcome to BD Daily Finance New Podcast, your daily briefing on finance and investing. It's 2025, December 26th, and today we're translating 3 big market signals into what you can actually do with your money.
And we're doing it in that magical week where trading volume is on vacation, but prices are still out here making life decisions. If your portfolio feels dramatic today, it's not you, it's the calendar.
On the rundown, Nvidia's reported roughly $20 billion purchase of Groq's assets, precious metals smashing records with silver breaching $75 an ounce, and oil rising on supply risk headlines tied to Venezuela shipments and Nigeria conflict.
So basically, chips, shiny rocks, and dinosaur juice. The holy trinity of why did my watch list just scream at me? Let's go.
Story 1. The headline. Nvidia is reportedly buying AI chip startup Groq's assets for about $20 billion, its largest deal on record if it closes. The market read is simple. Nvidia wants more control over inference performance and the software to hardware stack.
In normal person English, Nvidia is already the bouncer at the AI club, and now it's buying the coat check too. But why pay that much? Wasn't the whole point that Nvidia already wins?
Because winning in AI has 2 phases, training and inference. Training is building the brain. Inference is using the brain at scale, serving answers to millions of users with low latency and predictable cost. If inference becomes the bottleneck, the company that owns the fastest, most efficient inference pipeline protects margins across cloud and enterprise.
So it's like training is meal prep. Inference is running a restaurant on Friday night. You can have the best recipe, but if the kitchen can't plate fast enough, everyone leaves a 1-star review.
Exactly. And for investors, the question isn't just the price tag. It's whether consolidation tightens Nvidia's moat or signals that competition in inference is getting real enough to justify a major acquisition.
Also, debt investors are already acting like the party's getting expensive. One of the other headlines today, AI companies are borrowing billions and lenders are getting wary, meaning higher interest rates for the "we're totally profitable someday" crowd.
That's a key linkage. When capital costs rise, scale players get an advantage. If smaller AI infrastructure firms face loftier borrowing costs, the incumbents can buy capabilities instead of renting them, especially if the strategic goal is to secure supply and performance.
Action step for listeners. If you're holding AI-themed ETFs or a basket of semi-names, do a quick concentration check. If one ticker is basically your whole AI plan, that's not a plan, that's a crush.
And if you're a long-term investor, separate the narrative from the position size. You can be bullish on AI and still cap single stock exposure, rebalance on strength, and keep dry powder for volatility around deal headlines and regulatory scrutiny.
Story 2. Shiny things are acting like they just discovered caffeine. Gold, silver, and platinum hit fresh highs, and silver breached $75 an ounce. That's not a cute little move. That's a headline with shoulder pads.
What happened? Precious metals extended a historic end-of-year rally, supported by geopolitical tensions and U.S. dollar weakness, with markets also leaning into the idea of future rate cuts. Mechanically, lower expected real rates can boost non-yielding assets like gold and silver.
Simple version, when savings accounts feel less exciting, and the world feels more exciting, in the bad way, people buy metal. It's basically the financial equivalent of keeping a flashlight and bottled water in the closet.
Also, silver is a 2-hat asset, part monetary hedge, part industrial input. When momentum hits, it can overshoot because positioning gets crowded fast, especially in thin holiday liquidity. One related headline, a China silver fund reportedly turned away new investors after repeated risk warnings were ignored.
That's the most polite way to say, please stop YOLOing into silver. When a fund says, no thank you, we have enough money, you should hear the sirens.
Why it matters for normal people. Metals rallies can feed into inflation expectations and sentiment, and they can change portfolio correlations, especially if equities wobble. Practical move. Treat metals as a hedge sleeve, not a lottery ticket. Decide your target allocation range, then rebalance, rather than chase.
If your gold position just doubled, that's not a sign to tattoo AU on your arm. It's a sign to check if it accidentally became your retirement plan.
Story 3. Oil headed for its biggest weekly gain since late October, with traders tracking a partial U.S. blockade affecting crude shipments from Venezuela and a U.S. military strike against a militant group in Nigeria. Even if the physical impact is uncertain, the risk premium can reprice quickly.
Oil is that friend who hears a rumor and immediately changes the group chat vibe. One supply headline and suddenly everything costs more and everyone's mad at the gas pump.
The finance behind it. Energy is a key input into transportation and production, so oil spikes can bleed into headline inflation. That matters for interest rate expectations, which then ripple into stocks and bonds, especially if markets were already pricing in easier policy.
So if metals are the fear hedge, oil is the surprise bill. You don't want it, but it shows up anyway and ruins your nice, calm budget spreadsheet.
Actionable check. Look at your portfolio's inflation sensitivity. If you're heavy in long-duration bonds and growth stocks, consider whether you have any offset, like a modest energy allocation, TIPS exposure, or simply a larger cash buffer for near-term expenses.
Quick recap. AI is consolidating, metals are melting faces, and oil is reminding us geopolitics is a macro variable with a flamethrower. The common theme is scarcity. Scarce compute, scarce safe havens, scarce barrels.
Your weekend to-do list. 1. Check concentration in your AI exposure. 2. Set a metals allocation range and rebalance if you're outside it. 3. Stress test your budget and portfolio for a higher energy price quarter.
And if you're about to say, I'll do it in January, remember, January is just December with better marketing. Subscribe for tomorrow's briefing and send this to the friend who thinks diversification means owning 2 tech stocks.
Thanks for listening to BD Daily Finance News Podcast. If you want more episodes like this, follow the channel and check the playlist for the full week of market briefings. We'll see you next time.